Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have a very special guest in Mr. Cory Harelson, a dedicated mobile home park operator and the visionary founder of Freedom Investing Group. Before we dive in, I want to ask you a real quick favor. Would you mind please taking an extra 30 seconds to head over to wherever you listen to this podcast and give me a rating of 5 stars? This helps us get more listeners, and it means the absolute world to me. Thank you so much for making my day with that review of the show. All right, let's dive in. Leaving behind an 18-year career as a structural engineer, Cory took the leap into mobile home park ownership and now has a portfolio worth over $18 million across 12 communities, and he has been through 5 exits. His reach of his mobile home park portfolio extends from Idaho all the way to Ohio, with a focus now on the bourbon triangle, as he puts it, in the markets of Cincinnati, Lexington, and Louisville. He's currently under a contract on a park in Kentucky. And since July of 2023, Cory has dedicated himself to growing his mobile home park and RV syndication business, driven by a passion for financial freedom and helping others achieve it through mobile home park investing. Welcome to the show, Cory.
I am super excited to be here, Andrew. Thanks for having me.
Yeah. Would you mind starting out by telling us a little about your story and how in the world you went from being a structural engineer to investing in mobile home parks?
Sure thing. Yeah, I was doing like a lot of people did. I kind of did what my parents told me to do, right? I went to college and got a job and got married and had a kid. And I had some pretty good adventures before that. But at some point, my career kind of ballooned and I found myself with a young kid working 60 to 80-hour weeks and just not really being able to contemplate how I was going to continue to do that until I was 65, like everyone said you're supposed to do. And there was one particular week when my oldest son, he was my only son at the time, was 2 years old. There was a week where I just didn't see him at all awake. I would leave in the morning before he would wake up. I'd get home in the evening after he went to sleep. I mean, 7 days. It was just kind of bonkers. And I loved engineering. Like it's a really interesting thing, but I didn't love it more than my kid, right? My wife. So yeah, I had kind of this freak out where it was a Sunday and I had been working all day there. And I was like, I hadn't seen him awake in a week. I was like, gosh dang it, I'm going to go put my kid to bed. So I left work early on a Sunday at 5:30 and got home in time to actually give my kid a bath and put him to bed. But when I went to take him away from my wife to go give him his bath, he looked at me like I was a stranger and started freaking out and crying, didn't want to leave mom. And it was pretty terrible. I kind of had a realization at that moment I needed to do something different. I didn't know what that was. I did a couple things. Somebody gave me, it's the same book everybody talks about, right? Rich Dad, Poor Dad. And so, I read Rich Dad, Poor Dad and my mind kind of exploded like, oh my gosh, there's assets that pay you. Well, I don't know why I had to wait till I was 35 years old and read that, book to figure that out. It's not actually that complicated, but I wish I would have learned that in school. But yeah, so I read Rich Dad, Poor Dad and said, I'm going to go invest in real estate. Gosh darn it, I'm going to do this. And so we were not good savers up until that point. That was in 2015. We were not good savers up until that point. We didn't get in a bunch of debt or anything, but I like to climb and ski. And, if we had extra money, I was buying climbing gear and that kind of thing. And so, but we did have a little bit of money and we had some home equity. So I managed to figure out how to use a HELOC, and I was originally going to go do a duplex, threeplex, fourplex was what I was going to do. I went on to Bigger Pockets and just started nerding out, learning everything I could about real estate. And I figured out how to analyze deals. And I'm an engineer, so I built a spreadsheet, built my pro forma spreadsheet and figured out what all went in there and started analyzing deals. And even back in 2015, I had a really hard time. Once I started looking at them, it was like, man, these are barely going to cover the mortgage with the rent. And I know I could have, hustled and driven for dollars and, sent a bunch of mailers. And I know I could have found good deals in the duplex, in the kind of plex space, but I was getting a little discouraged and I stumbled across a mobile home park for sale on Craigslist, a little 9-unit one. I didn't end up buying it, but I plugged that into my pro forma spreadsheet and the numbers looked much better. And so I was like, what is this mobile home park thing? So I started doing what I always do. And I dove in and I learned everything I could. I got a bunch of Frank Rolfe material back then and learned about tenant-owned homes and park-owned homes and cap rates and all of that. But I was still pretty scared because it's a mobile home park. And what did I know about mobile home parks? So I had a really good friend of mine, Matt. He was the only person I knew at the time who invested in real estate. He's a residential real estate agent, but he had rental properties and things. So I took him out for a beer and I said, Matt, I'm thinking of doing something crazy and I need you to talk me out of it. And I need you to tell me why. I said, I'm thinking of buying a mobile home park. He looks at me and goes, no, I know guys who own mobile home parks. They're cash cows. So he ended up helping me quite a bit as far as how to track down a deal. So we sent a bunch of mailers out, and at the time they weren't popular yet. That was still kind of right at the tail end of them being a secret. And so, yeah, we just sent a bunch of mailers out and a whole bunch of people responded and we had a bunch of deals on the table to choose from. And I ended up buying my first park in 2016. It was a little 12-unit deal in Garden City, Idaho.
Garden City, Idaho. Maybe tell us about that because you're based in Boise, right?
Correct. Yes. This was 10-minute bike ride from my house.
Oh, awesome.
To this. Yeah. And so Garden City is a kind of a neat little niche in Idaho in that it's a beautiful area surrounding it. And it's right on the river, right on the green belt. And there's breweries and wineries, but there's just all these really, really old rundown properties around there. So it was right in kind of the path of progress, if you will. And that everything, it was just that area that it was like, this is way too nice of a location for things to be. Yes, exactly. So it was a good spot to buy at the time. And yeah, it was 12 units.
12 units. Okay.
12 awesome. Units, all tenant owned. There was one unit. There was 11 really good tenants and one that we knew was going to be an issue. He was high as a kite when I went to walk the property in due diligence, and the inside of his home was like, all the other homes were okay, but this one home was just in really bad shape. He had just put like cardboard up on the ceilings and stuff. It was really bad. And so he did us a favor right out of the gate and stopped paying. So we got rid of him and replaced the home with a nicer one and filled it with a sweet little old lady who had just gotten divorced. And yeah, ended up being a really good deal. We built back some water and yeah, it was really good. And it took a little bit of doing for the first year, and then was kind of just mailbox money for several years after that. So that was my first mobile home park.
On that one?
I don't. I sold that. I did a cash out refi on that and bought a park in 2020. And then I sold it and refinanced a little over a year after that, or sold it in 1031. Sorry. I kind of wish I did, but it's in a great spot.
Yeah. Tell us about, how you got educated prior to buying that 12 unit. I know you mentioned some bigger pockets and Frank Rolfe stuff, but yeah, what did you go to the boot camp? What type of stuff did you do to, for due diligence and things like that?
So what I did, I would do it different. I would have gone to the boot camp sooner if I had it to do over again, but I got all of the free material. They had at the time, I don't know if it's still available. They had a bunch of really good free material on the Bigger Pockets forum, but also on the MHU, the Frank Rolfe Mobile Home University site. So I ended up just getting that and then kind of figuring out, piecing that together with the forums and coming up with a due diligence list. And you can learn a lot for free. In hindsight, that deal went really well. I had one other deal that didn't go as great, and I think I would have approached it differently had I taken the MHU boot camp sooner. So yeah, the boot camp was great. I did the boot camp in January of 21. I finally went and did when we were going to start. At some point, I had used up all my capital and thought I was done. And then I had some friends and family come and say, "Hey, why don't you take our money and do this too? And this is really cool what you're doing." And so I figured I had 5 years of experience at that point, but I wanted to make sure I was leaving no stone unturned. So I went back and took the boot camp 5 years in.
Smart. No, yeah. That's awesome. I mean, on those first couple, did you make any mistakes? What would you do differently? On those first couple, like what you were mentioning, did you buy any private utilities or anything like that, or were they all public?
So the one that I made a mistake on, so the first deal was City Water, City Sewer, that 12-unit one. It was actually, everyone says your first deal, you lose on, and then you learn all the lessons. I wish I had lost on that one. That one went just too clean. The deal that I cash out refied into, first I bought that one, then I bought a few other small ones in Garden City, one over in Pocatello, and then I at one point I sold a few of those and refied the first deal, and I bought a 51 lot park in Michigan. That was like, oh, I'm going to scale up. I did this. I bought this 51 lot park. That was in Michigan. That one had a wastewater treatment plant, which rightfully worried me going in. So I did everything I could to learn all about the due diligence you would do on those. I talked to other people who'd invested in them. I found all the material I could. I posted and got good responses on the Bigger Pocket forums. I checked with the local, the state, the federal, EPA people. Everything was in compliance. They had a good operator. Everything seemed to be, I checked all the boxes that I think I should have checked. But I made one mistake, and it was a small mistake, but a big mistake. When I was insuring it, I took the appraiser's word for the value of the replacement cost of the wastewater treatment plant. That was the big mistake. I should have, for something like that, in hindsight, if I was going to do this again, I would go talk to an actual contractor and a manufacturer called Legacy Environmental, or somebody that makes these, and get the actual price, because that ended up being off by a factor of 10. And everything was fine with the operations of the plant. And a lot of these plants are outdoors and they're not flammable, so that's fine. This one happened to be housed in a building. It had a building that was housing it. The building had a fire.
Oh, geez.
And it totaled the plant.
Oh, my goodness.
Yeah. So that was rough. That was a big, big mistake. So that one thing right there, if I had just gotten the insurance right, then it would have just been a headache. But so it got totaled, and it was very expensive to replace it. We did have some insurance, and I was pretty worried for a minute there. I mean, thank goodness it was just my park, and I hadn't, this wasn't someone that I had other money in.
Yeah.
But yeah, so I didn't know what to, I was calling everybody I knew, trying to figure out what to do. And the best advice I got was from my friend Blake, who was like, you just got to call the bank and just level with them. Like, cause it was the pumping of the sewage while the thing was being replaced. Ended up costing almost as much as the replacement. Yeah. It was $50,000 a month.
Oh my goodness.
On a park with, like, the gross income was $300,000 for the year. So it wouldn't work. So the insurance covered that for a few months, that pumping, but so I had just a few months to figure it out. But fortunately I had done the other things right. I had built back water, filled vacancies. I boosted the NOI way up, and I had a little bit of market wins at my back at the time too. So I had some pretty good equity in the property. So the bank was great to work with.
Goodness. Yeah.
Yes. Yeah. John Metternach was the lender on that one. He was awesome to work with. And so we ended up doing like a cash out refinance in the middle of it to fund the gap between, I put a whole bunch of cash in from, I had cash savings and everything. So I had my reserves plus the insurance. We ended up doing the whole replacement of the wastewater treatment plant. So we replaced the whole thing. And that would have been, if I didn't have to, if I got the insurance right and done everything else the same, I would have tripled my money in 2 years on that deal. But instead I ended up losing a bit.
For the listeners, what a great takeaway. Yeah. I mean, if you're an operator out there, definitely get like the actual replacement costs instead of taking the appraiser's, valuation. That's a great takeaway. So,
right. And if it's some building, that's what appraisers are there for, right? They're pretty good at it, but they may not know. I'm assuming they're not a wastewater treatment plant expert. So yeah, so that's the takeaway on that one. It ended up, I would say that it ended up, I'm kind of just trying to think of it as a college education and infrastructure replacement, I guess. And we did end up finding another deal based off of that I took that I would not have had the courage to touch if I hadn't been through that. So we found one in Illinois that had an owner who was in a similar situation to what I was in. They had a failing well water system that needed to be replaced, and they didn't have the capital to replace it. So we were able, and I had just gone through this wastewater treatment plant thing, and it was like, well, I know what to do. I come from a construction background, so it was, it's a totally different thing when you come in with the actual capital to do it and it's planned. But so we were able to get a really good price on it to start. And then we got a seller credit for the vast majority of the actual replacement. So we were able to cash out the seller who was in a pickle, kind of get him out of the pickle, and come in. And we did a $600,000 well system replacement at a community in Illinois now it's got brand new infrastructure. And out of the 600, we got a $480,000. It was a $570,000 replacement. We got a $480,000 credit. So we were basically into it for 90, and now we've got brand new Illinois EPA compliant well system, and it's 100% tenant owned. Like, other than that infrastructure thing. It's just a super quiet cash flow mailbox money park. So
that is so good. No, thank you for sharing this. I mean, I know we kind of went down a rabbit hole here, but like, what would you say, Cory, are like the toughest hurdles that you've had to overcome in mobile home park investing? Like looking at it from like an all-encompassing perspective. What's the toughest hurdles? Is it, utility system management? Is it operations? Is it, finding good deals? What would you say?
I think everybody knows it's hard to find good deals. I mean, it's certainly, there's a lot of work there that goes into finding good deals, but I think the operations is probably the biggest one that a lot of people will just say like, oh, it's tenant-owned homes, and if the toilet leaks, it's not your toilet, and that's true. But
you have a vested
as long as you're
in that toilet, so you don't want it to just
right. Yeah, that's true until until maybe you inherit one of those homes and have to refurb it and sell it, and you can make a profit on that. But it's the operations are a lot more work than I had thought going in as far as figuring those out. And so we've learned a lot. I feel like we've got some pretty good processes now, but that took a long time to build, I would say.
Yeah, tell us about your operations. Do you manage in-house, and, do you have a team, and what does that look like?
Yeah, we do. So we do manage in-house. I have a separate Freedom Community Management is our separate entity that does the property management. So we have a couple of virtual employees who help manage kind of the global back office, bookkeeping and supporting of on-site managers. Then we have on-site managers at every property as well, and those folks make a big difference as far as finding the right folks there is a key. And then what we do is,
any tips on finding good on-site managers?
The best ones we've hired have been straight out of the Frank Rolf boot camp of just going and figuring out who's got the nice home and the clean car and the nice yard, and who actually looks like they care, and that they want to be motivated. They're going to be motivated to want to make the community better. That's what we've done, and that's worked pretty well. Some of the inherited managers we've gotten have worked well, and some of them have not. But when we've hired based on that criteria, just make a list of the top 10% of who's got the nicest yards and talk to all of them. The park we have down in Tucson, we did that, and we talked to everybody. And the guy that we ended up hiring, his wife's grandpa was the one who had built the park, and whoever they had sold it to had let it go down a little bit. And so he offered to do the whole thing for free. He was like, I just want to see this place cleaned up. I'll do all of this for free. And we're like, you can't work for free. We're going to pay you, because otherwise you're going to burn out. And he's still with us. He's awesome. Like, he's like that. We've cleaned that place up, and it's running like clockwork. So
a good on-site manager can make or break a deal. It would make it 10 times easier if you have a good manager that you can trust. So that's a good tip. Thank you. Tell us about, your recent acquisitions. Kind of, I know you've ballooned up now. You have a nice portfolio. How have you guys pivoted around the higher interest rates? And I know you said you had a deal in Kentucky under contract. So yeah, maybe just kind of tell us about your portfolio now.
Totally. So what we have done up until recently, we have made relationships with several brokers we have really good relationships with that are sending us pocket listings. And so what we have done is we've chased the relationships instead of the region. It's been good in the sense that we have a lot of good deals with us right now. And it's been good that it's let us see a lot of areas. I do think every time we end up in a new area, it's a lot of work. And so we've decided, so we're in Cincinnati and soon to be the Lexington metros. And I really like those areas compared to a lot of the other places. Like the Illinois property is great, but the state of Illinois is not great to work with. And so we found some areas that the operations seem like really, really good. And we can use a lot of the same movers and installers between those three markets. Are only an hour and a half apart. So we're right now, we're honing in on what we're calling the bourbon triangle, the Lexington, Louisville, Cincinnati is where we're currently targeting. Great areas. They're growing. They're popular. The Lexington, where our deal's under contract right now, it's the housing supply is constrained because they're kind of anti-development. So there's not a lot of development, but there is a lot of demand. So where the rest of the country last year rents were down, the rents last year in Lexington were up over 5% still. So it's a really strong area, and it just seems like I've seen firsthand the red states are just so much easier to work in, regardless of what your politics are.
No, totally. Yeah, I own a park in Buffalo, New York, and then a couple actually in Illinois. And it's just amazing, specifically we could talk about, evictions, but there's other things too, right? Like just the regulation behind bringing in a home and, filling it, the permitting process is like 10 times harder and longer and more expensive. But yeah, I agree. The red states, things just move a little bit faster and you're able to, do business. So that's good. Is that where most of your deals come from though? Is like pocket listings and those relationships with brokers?
So I certainly make a bunch of cold calls, but the most traction we have had is through the pocket listings with brokers. Yes.
That's awesome. That's great.
Yes.
Yeah, that's a good little lead source. It takes a lot of time to like build those relationships, but that's great that you have a good, stream of deals coming to you. Cory, how has your mobile home park investing strategy changed over your years in the business? I know you said now you're kind of getting more geographic focused on the Bourbon Triangle, but is there anything else like size-wise? Your first deal was 12 units. Now, are you looking at bigger properties like the one in Michigan that was over 50 lots? What's changed and why, if you don't mind?
Yes. So we are looking at bigger parks, definitely. So our current metric, we're targeting 50 lots and bigger, unless it's right next door to one that we already own. Then we'll go down below that a little bit. But nice. I have this theory that the 50 to 99 lot is kind of a sweet spot. The bigger parks, you just get so much more economy of scale. It's not really more work, but then you have more revenue to hire better people to execute the work. You can actually afford to have an on-site manager you can actually afford to pay your on-site manager a decent wage. And so I think that's huge. I like the 50 to 99 lot size because I would like bigger parks too, but a lot of the really, really big folks start looking at the 100 lot and up range. So I feel like that 50 to 99 kind of weeds out some of the really, really big operators, but it's big enough that a lot of the first time buyers aren't able to get into that space. So that's my sweet spot there.
That's good. And yeah, what's the strategy? Is it value add? Is it more stabilized? Are you doing a lot of infill? I know you said you sub-metered, that one park, water and sewer. What's the play for your portfolio?
So I think, and this is maybe a good comparison that I like to make sometimes too with apartments. I feel like the value add potential in mobile home parks is the best of any asset class because so many of them, they're all built in the 50s, 60s, and 70s. And so many of them have these owners who've owned them for decades and haven't done anything. They haven't fixed potholes. They haven't filled vacancies. I assume their loans are paid off and they've just, whatever money's coming in is just cash flow. And so they're not really motivated to improve them. So in the apartment space where there's so many sophisticated sponsors out there, there's certainly value add deals there too. But I think they're a lot fewer and far between versus a lot of these parks just have so much value. So for instance, this park in Lexington is in a wonderful location. It's right next to there were bulldozers driving behind the fence as we were on site touring it, building a $500,000 kind of McMansion neighborhood right behind it. There's a middle school getting built across the street from it. The location's amazing. The infrastructure is direct build, water, sewer right to the residents. So the maintenance of the pipes, none of that is on us, the water sewer bill. So the infrastructure is great. The bones are great. The location's great. But it's ugly as sin. It's like, this is way too nice of an area for this thing to be here. But if it's just aesthetics, we can fix that. So that's what's exciting to me is there's a whole bunch of longtime residents in this thing that are living in this place that's just not been kept up. The roads are crap. The trees are all overgrown. There's, so if we can come in and fix the roads and do fencing and signage and help some of the residents, especially up near the front, maybe paint their homes and do a program to help residents get skirting on their homes and enforce make people clean up their yards and get rid of some junk. All of a sudden, we're going to have a nice asset in a nice area and we're going to be able to fill it up. And then, so I like the infill. I like value add as long as it's priced so that we can afford to bring in the capital to do the value add, if that makes sense.
Sure. Yeah. So, and then you handle that all in-house through your team. You have like project managers to do that, or are you doing it yourself?
Correct. Yeah, we have. So my partner, so my business partner, Thomas, who's also my brother-in-law, he runs a lot of the value add stuff. And then we've got our team will work with the on-site manager for the operations and automating rent collection and all of that. And then we actually started working somewhat recently with, there's a consultant called Dynamic MH Solutions. They've got decades and decades of experience. So we work with them a lot on particularly on like the home infill and inventory. And they've got relationships to get good prices on a lot of homes and things. So we've just started working with them a few months ago.
I'm not familiar with them. Dynamic MH Solutions. And will they handle infill and things like that? Like actual, like from manufacturers, or are they helping with used homes? What type of?
They can do both. They can do both. So they've got a bunch of relationships with lenders. They've got relationships with some of the new home builders. So our plan is to kind of do a combination of newer used homes and new homes via the 21st Mortgage Cash Program. And so they've got relationships with all of them, and it's almost like having they're kind of like a fractional employee almost, but they've got tons and tons of experience. They've all been doing it for decades. So.
That's so awesome. And to circle back, you mentioned that like in mobile home parks, the value add is just so transparent. There's just so many ways to add dollars to the NOI by just walking around because of the fragmented ownership and things like that. And I think that's just so important, right? Because in apartments and storage and all these other asset classes that are still attractive and and they can work. I think it's just a little bit harder, right? It's a little more arbitrary. It's a little more like less clear, right? In mobile home park, it's like, hey, here's a 80 lot park. There's 10 vacant lots. Here's our plan. And here's how we're going to use the equity to fill those lots and increase the income. It's very black and white. Where like in storage, for example, it's like, hey, we're going to buy this facility. It's 92% occupied and we're going to revenue manage people up, but we don't know how many people are going to move out, but we're going to revenue manage people up. And, we believe we'll be able to, push NOI based off of that. It's just more, it's less concrete, I guess. Would you agree?
Totally. And I think part of another thing I love about the mobile home parks versus self-storage and apartments is because the rents are so far. I know like rent increases are a touchy subject, and we certainly try to bring people in at market and bring the existing residents over many, many years. So I'm not someone who's going to come in and double everybody's rent overnight. I don't feel right about that. But we are going to get them there over some number of years. We're going to catch them up, and that's how we can afford to bring in the capital to do all these improvements. Yeah. But the neat thing is I like to think of them like a submarine under a storm. So the apartments are like the ship on top of the sea. And so right now, last year, a lot of people got into a lot of trouble with apartments because rents had been shooting up in the apartment side of things, but they are by definition the market rent. The apartment rents are the market rent. And so if the market rent comes down, all of a sudden you've got syndications where people are projecting rent growth and they have to cut rents, and you can be in big trouble. But with a mobile home park, the rents are so low. Like our most expensive park is around $500 a month in a market where the rents are $2,000 a month for apartments. So if the apartment rent drops even by some big 10 or 15%, okay, apartments are $1,800. My $500 lot rent is still a bargain. And so if we've got residents at 200 and something, we're still going to bring them. We're sticking to our business plan. So I like that. Because it's affordable housing, and it's so much, it's actually affordable. It doesn't need Section 8 subsidies for people to afford it. People can actually afford it on minimum wage salaries. And so that's what's I feel good because we're providing housing that people actually need, and we're trying to make it quality housing. And then B, people can actually afford to pay it. So I don't feel like we're as impacted by the ups and the downs of the housing market.
Yeah.
Not sure if that made sense.
Feedback. Yeah. No, I agree with you on that. If you were going to be passively investing in another mobile home park operator, what would be like the major things that you would want to look at and study, and what would you want to do, I guess? What's your advice for those passive investors that are listening?
Totally. Yeah. So there's 3 things I would look at, and I've actually got a free tool for one of those things. The first thing would be the sponsor. Do you trust this person? Do they have a track record? What has their performance been? Really, like you're investing. If you're investing passively, you're giving up control, which is good because then you don't have to do work, and it also limits your liabilities. There's a lot of pros, but you really have to trust the person you're investing with, right? So I would say what you really want to meet and talk to them and understand who they are and what their background is, and make sure it's not somebody that's just going to skip town with your money, and make sure that they have the capability to execute on their business plan. The second thing I would look at is the financing. I would be just and I don't think this has happened as much in the mobile home park space as the apartments, but I'm just a fan of debt that's fixed for at least 5 years. That a lot of people got in trouble with the interest rate spikes and everything recently. And so if you've got commercial loans, if you can get 5 or 10 year debt, I feel like that's really good. So that's one thing I would be cautious of, is if there's some kind of variable rate debt, unless there's a reason for it. Maybe if it's construct, you're building something new or something. And then the third thing is and then finally you get to the deal itself. And so for the deal itself, there's all kinds of weeds you can get into about what to look at. I actually made a tool. It uses, so Frank Rolfe has his, he popularized the ideal method of looking at a deal as far as what to look at. So that's infrastructure, density, economics, age of homes, and location. So I created a tool where you can go and you can set it up with whatever your parameters are. And it's meant to be, if you don't want to do a full underwrite. So I use this every day just for a quick pass. It takes 15 minutes to set something up instead of 8 hours to do a full underwriting model. Yep. So it's kind of a quick pass to see, hey, it's checking all these things. I've got color coded cells for all of the different metrics. Like, is this all the different location metrics, median income, population, all the metrics for all those things. So you can kind of get this real quick snapshot of, is everything green, or is there a bunch of yellows and reds? Is this something I even want to look at? And then it runs through, like, it's not a full underwrite, but it runs through kind of a 80% the way there, best guess underwrite as well. And it's pretty easy to use. So I use that to process a whole bunch of deals. But if anybody wants that, I've got that, I can share that for free as well if anybody wants it. And it's I think a good way to just have something where you can actually make a buy box and you can write down what you want your targets to be, and then objectively look at those in a pretty visual, easy way.
That's awesome. Yeah. If you could send the link or whatnot, I'll make sure to put that in the show notes. That'd be awesome.
Yeah, absolutely.
Moving on from that, what do you think the perfect mobile home park looks like? What does that look like from your time since 2016 when you bought that first park, the 12 units in Garden City, Idaho, to now? What's the perfect park look like, and why?
For me, the perfect park is in a great location, but with some form of value that needs to be added. I like the value add stuff more than the stabilized investments, just because you can provide a better return. And I feel like we're making places better for people to live. So it would be some kind of value add where that either means it's an ugly park that we're bringing back to life and making look nicer. It's got empty pads that, hey, that we need affordable housing. Let's go provide some more affordable housing. We're actually adding units by bringing homes in and selling them, or infrastructure like the one in Illinois, where we basically saved that community. If they didn't replace that well system, I imagine they would have had to shut the community down. So some kind of value where we're actually adding real value to a park in a great location is what I would say. For me, the location's the biggest thing, because it makes everything easier when there's a lot of demand for what you're providing.
Totally. Interest rates are pretty high right now. We're still getting quoted 7.5% interest rates on deals. How are you guys pivoting around that? Are you doing anything special? Obviously you're buying value add deals that have room for, rent growth and infill and things like that. But is there any magic sauce that, maybe we could just, be comfortable with?
I don't think there's a magic sauce. You've got to update your underwriting and just plan on, you got to pay less for the deal at the end of the day, because you've got to, unless you're someone who's coming in with all cash but then your returns aren't going to be as good. So I think you've just got to pay less for the deal. The deal can support less debt. And so it has been a challenge getting deals to pencil this last year, because we've looked at a lot and offered on a lot, and there's just been a gap because everybody remembers what it would have been when interest rates were 3%, but the property can't support that debt now. So it just doesn't work. The one thing I have been trying and gone pretty close on a few is to get creative. If you've got an owner who owns it with no or little debt, try to do an owner financing kind of scenario where if they could, I actually had a verbal commitment on one and then he changed his mind. But if I was an owner, what I would do, if I was an owner selling and I owned the property outright, what I would do is offer a low interest seller finance loan for a decent term, so that you could sell for a higher price. Like if the issue is just the cap, it's just the spread between the interest rate and the cap rate. And so if you can provide a lower interest rate for a long enough time, then you should be able to command a higher price for your property. So they're making a return right up front by selling the property for much more than they could have sold it for. And then in exchange,
right?
we're getting in on a long-term loan with low interest rate that's going to cash flow for a really, really long time. Then, I think there's a win-win there. So that would be that's one thing I'm trying.
Yeah, no, that's a great idea. That we're using that as well. They get the seller to hold like a second, right? So there's a first position, and then they're holding like a second to kind of help bridge some of the gaps. So that's a good way to look at it. So let's invert for a second here. How does a person fail with a mobile home park investment? Knowing what how does a person fail?
I would say you fail by selling when the market is selling at the wrong time would be one major way to fail. So I think the defense for that is to buy parks that cash flow and that have value adds that you can really boost the value and the revenue to protect yourself, and taking longer term debt. I think one of the scary things I have seen a lot of seller finance deals come in, but they want a 1 or 2 year balloon on it. And I think that's really scary. I think that could lead you to overpaying for a property. And then even if everything's going right and you're making your payments, 2 years go by and you overpaid, so you maybe can't refinance out. And then you lose the property to term default, even if everything else went well. That's scary. So I that's why I favor those longer term loans. And then also looking in the underwriting at what happens. Can you refinance out if your NOI takes a hit or the cap rates go up? Yeah. So I think
the financing is what you focus on mostly. Is, hey, don't mess that part up. Number 2 and your 3, right. Don't mess up the financing, because that could lose your capital.
Correct. Yes. And then obviously, like I said earlier, don't ignore the infrastructure either, especially if you have private infrastructure. Make sure you get the insurance right on that.
Because you could do all the right due diligence like you did and still, have an issue because of the insurance piece. So that's
yep.
a big takeaway for listeners. So thank you for that. Yeah. What do you think is the biggest threat to mobile home park investing?
I think just as it gets more popular, I think you can overpay if you're not being careful. I know where I'm at in Boise. I was talking to a friend of mine who's a commercial broker. I don't have any properties in Idaho anymore. I would love to be invested in my own home market, but I can't. It's a game that I don't really understand the rules to anymore. They're still selling at sub 5 caps. They're just people buying with negative leverage. So my friend, he does apartments and mobile home parks are his 2 specialties. And he said the parks are selling at lower cap rates than the apartments right now because of their stable track record throughout all the turbulent times and recessions. I want cash flow, or I want to be able to know I can raise the value to get to cash flow. I just don't understand. So yeah, I think the overpaying would be, some of these big groups that are buying things at 3 and 4 caps still.
Yeah, you can change a lot of things about the property itself, but you can't change the market and you can't change the price you paid, right? Like after you close, those are pretty locked in. So yeah, good point there. Well, Cory, thank you so much, dude, for coming on the show. You've added a ton of value. If any of our listeners would like to get a hold of you, what would be the best way for them to do so?
Yeah, you can find us at freedominvestinggroup.com. And we've got that. You can get a link to that free resource there too, or I'll send a link to it for the show notes too. Or you can, if you want to email me, it's Cory is my name at freedomcm.net, as in Freedom Community Management. So thanks. Awesome. It's been fun.
Yeah. Anything else that we missed, Cory, or any other advice you'd like to give, passive investors that are looking at mobile home parks as an asset class?
Yeah, I think it's great. I think it's kind of a double win. I mean, you've got this thing where you can build your cash flow and your equity, and you're also providing something there's a crisis right now in the country with affordable housing. And if you start to operate in this mobile home park space, you see it when we have a lot come available. I mean, we get mobbed with people that need the homes and people that really, really need housing. And so it's a way to provide good quality, affordable housing and make a return. So it's a pretty cool double win. So
double win. I love that. Well, Cory, thanks again for coming on the show.
Yeah. Thanks, Andrew.
That's it for today, folks. Reminder, please leave a review if you got value out of this show, wherever you listen to your podcasts. And thanks again for tuning in.
Hey, are you getting value out of this show? If so, would you mind please going over to iTunes and leaving the show a quick 5-star review? I have a goal of hitting over 100 5-star reviews by the end of 2021. and it would mean the absolute world to me if you could help contribute to that. Thanks ahead of time for making my day with your 5-star review of the show.